Trading can feel impossible until you know these things. I've had people come to me when they were one losing trade away from quitting forever. They'd blown up their accounts multiple times, spent thousands of hours studying, and they thought they just weren't smart enough for this. I shared with each of them the one thing that changed everything. You don't need to predict where the price will go. After extracting this principle into their trading routine, their win rate has steadily stayed over 60%. Losses got smaller and their confidence came back. Now, I call it the one thing because it's one shift in mindset. I broke it down into 3 specific rules to follow on every single trade. And in today's video, I'll walk you through all 3 step by step. Let me start with the one that will save you from the most expensive mistake retail traders make every single day. Step 1, mark your levels. And by levels, I mean support and resistance, all-time high, previous day low, previous day close. What they were doing wrong before was marking these levels and then jumping straight in the moment price touched one of these levels. If price hit support, they would buy it. If price broke resistance, they would chase the breakout. They were doing exactly what every other retail trader was doing. And that never ends well if you actually want to make money playing the markets. And this is because the whales, like big banks, funds, market makers, they know where all our orders tend to be clustered. What many traders fail to understand is that these levels aren't true entry signals. They're liquidity traps. Big money pushes price just far enough to trigger all the stop losses and the breakout entries. And you've seen this happen. Price breaks above resistance and you buy the breakout. And then immediately it reverses or drops, or price drops to support. You buy thinking it'll bounce and it just keeps falling. This, my friend, that's not bad luck. This is you getting caught in a liquidity trap. The difference now is understanding these levels are not entry points. They're just reference points that tell you where to pay attention, where the institutions are likely hunting for liquidity. Think of it like a lighthouse making a harbor. Everyone sees the light and rushes in thinking it's a go signal. But the real danger is the current below the surface. The big ships, or the big money, use that moment to create waves that pull small boats off balance. The lighthouse, or the signals, don't mean go, they mean watch. Same with trading levels. They show you where things might happen, not when to enter. The actual trade happens just away from that level, after the trap has played out. This is when the price is moving with real strength and clearly in one direction. When you wait for confirmation, you allow the price to show you where it's going. That's where you start trading with the institutions, meaning you're no longer the liquidity that they're hunting for. And if you're getting value from this so far, hit that subscribe button. I break down trading concepts like this every week, and I don't want you to miss the next one. But how do you actually know when you have a real confirmation? Which is this: waiting for follow-through strength. Think of a goalkeeper during a penalty kick. They don't dive in the second the striker moves. They watch the body language, the hips, the foot placement, the momentum. Only when everything aligns do they commit. That's exactly how you should think about confirmation in trading. Don't dive in early. Wait for the move to actually show you its direction. So let me explain. Before, you'd see price start moving away from a key level and jump in immediately if the first candlestick showed momentum. Traders think that was confirmation and didn't want to miss the move. Think of FOMO, fear of missing out. But now, wait for 1 to 3 candles to confirm if that strength actually is likely to continue. I know it feels like forever when you're watching the chart, but use those candles to ask yourself this key question: is the price actually holding above the level if it broke higher, or below the level if it broke lower? Or is it holding the support or holding the resistance? Because if it's not holding, it means the move doesn't have legs and it won't run. Also, check volume levels, known as volume profile. Is there already large size that has participated at that level? This tells you institutions are participating. That is a green flag right there. But if volume is low, it's probably just retail traders, and the move is likely to fail. As you can see, by analyzing these three variables, price holding support, momentum building, and volume confirmation, you're no longer taking guesses. Instead, you're taking high probability setups. When all three of those variables align, that's your entry. Now you might be thinking, you're good to go and ready to smash the markets. Wrong. One more critical piece of context. You need to be able to zoom out. This is where time frames come into play. Because if you're taking trades on a tick chart, you're basically trading without the whole picture. First, check a higher time frame, like a daily, for structure and setup. Most traders do not look at setups on a longer term time frame or even the overall structure. The daily time frame reflects the overall trend and where price is actually trying to go. This will give you a clear directional view for longer term trades. Second, check for choppiness. If it is choppy, you probably shouldn't be trading at all, since trends favor follow through. Once you have your directional view, you can scan for entries for a short, intermediate, or long-term trade. There will be one where I'm looking for my precise entry. And at this point, I've already compared the time frames. For example, the 5-minute, the 1 hour, or the daily for a trade, and I've chosen the best setup. No alignment, no trade. Remember that there is zero shame in not trading. The best trade sometimes is no trade. Flat is a position. With this new mindset, you learn how to reject bad trades without second guessing yourself that much. And as a trader, that is a superpower. Think of trading like surfing. You don't paddle at the very first ripple. Instead, you mark the levels, watch the test, and then paddle hard only when the wave actually begins to form. That's when the institutions are paddling with you and not at you. And because everything is stacked in their favor, your win rate will be higher. This doesn't mean that you won't lose. You will, of course, sometimes, but in the end, the odds will be in your favor and you will be profitable. So let me bring this all together for you. Your edge comes from three non-negotiable principles. First, mark your levels, but don't enter yet. The entry is just after price rejects the line. Second, wait for follow-through strength. Give it 1 to 3 candles, preferably a pattern like a minor low or a doji or a marubozu, which, by the way, is integral to fair value gaps. Watch if the price holds. Check if volume is higher than the average using volume profile, like perhaps a point of control. That size is institutional participation. And third, zoom out and compare. Compare multiple time frames for the best setup. Now, you know you don't need to catch every move to be profitable. You just need to catch the confirmed moves. But we're just scratching the surface of the signals that you need to make your winning rate as high as possible. If you want help implementing this system into your trading, I work with a group of traders where we go through charts, setups, and I show you exactly how to spot these high probability entries in real time. Make sure to check the links in the description below for more details. And if you want to keep leveling up your trading, and who doesn't, I've got another video for you that builds on what we've just covered here together. It's popping up on your screen right now, so be sure to check it out. Now, go be patient, wait for your setups, and I'll see you in the next one.